All right, let's talk about Sri Lanka's banking sector, because right now it's telling two completely different stories at the same time. On the surface, we are seeing absolutely record-breaking profits. But if you look just a little deeper, under the hood, there is a massive shift happening that could change, well, pretty much everything. So let's dive in.
And this really gets us to the heart of the puzzle we're going to unpack today. The numbers look amazing, right? Profits are just through the roof. But then you look at the stock market, and investors seem, well, cautious. So what's really going on here? Why is there such a disconnect?
Well, the whole story lies in this dual reality that the entire sector is facing. On one side, you've got that incredible profitability, which was largely fueled by the high interest rate environment we've been in. But, and this is a big but, on the other side, that whole environment is changing. Interest rates are coming down, and folks, that changes the entire playbook.
So if you're a bank, how do you navigate this? What's the new strategy? Well, the answer, in one word, is efficiency. You see, in a world of falling interest rates, it's not about just being the biggest bank anymore. Nope, it's about being the leanest, the most efficient operation. Let's see what the data shows us.
Now, this chart is fascinating because it shows the divide so clearly. This measures the cost-to-income ratio. Basically, it's how much it costs a bank to earn 1 rupee. And you have these clear leaders like Nations Trust Bank and Bank of Ceylon with incredibly low ratios. I mean, they are true efficiency machines. Then, on the other end of the spectrum, you have banks with much higher costs, at least for now.
But hold on, a high-cost figure isn't always a red flag. For banks like STB and Union Bank, this actually signals they're in a transformation phase. They're spending big today on new systems, on new networks, all with the goal of becoming way more efficient tomorrow. The big question for them is whether they can pull it off and protect their profit margins down the line.
Okay, so this whole focus on efficiency and transformation brings us right back to that central puzzle, the valuation mystery. Why aren't these massive profit numbers translating into soaring stock prices? To really get it, we've got to look past those big, flashy headlines.
Okay, just look at this number for a second. NDB Bank posted a staggering 145.6% year-on-year profit growth. I mean, on the surface, that is absolutely phenomenal. You would think investors would be lining up around the block, right? But
Look at its valuation, a price-to-book value of 0.73x. What that means is the market values the entire bank at less than what its own assets are worth on paper. Think about that. You could theoretically buy the bank for less than its parts. This just perfectly illustrates that disconnect we're talking about. So what is the missing piece here?
you know, it's not fear, it's just caution. Smart investors are all asking the same question. Is this sustainable? They know the high interest rate party is winding down, and they're waiting to see which banks can really perform when things get back to normal. HNB's low price-to-earnings ratio is a perfect example of this exact wait-and-see attitude across the market. And we're about to dive even deeper into what really makes these banks tick. So if you're finding this deep dive into the engine room of Sri Lankan banks helpful, now's a great time to hit that like button and subscribe to Ceylon Premier Analytics for more fundamental insights just like this. All right, so beyond sustainability, there's another huge factor at play here: risk. The market is smart, and it's applying what's known as a risk premium. It's basically sizing up the quality of each bank's loan book. Or to put it really simply, how safe are its loans?
And this slide just nails that concept perfectly. It shows the ratio of non-performing loans, the bad loans. On one side, you have HNB with a squeaky clean loan book, just 1.4%. Now compare that to BOC at 6.7%. Investors see that difference and they price that risk right into the stock. They are absolutely rewarding the banks with the cleanest balance sheets.
So we've seen how investors are pricing in risk. Now let's look ahead. As those interest rates keep falling, banks are going to face a brand new challenge. It's called the NIM squeeze. And the big question is, who has the best shield to protect themselves from it?
So what is a NIM squeeze? Well, it's exactly what it sounds like. A bank's profit margin gets squeezed. That gap between what they earn on loans and what they have to pay out on deposits starts to get smaller and smaller. And it's already happening. NTB's margin is down, Sampit's is down. The era of easy money is officially coming to an end.
So how do you defend against the squeeze? What's the shield? Well, the ultimate stabilizer is having a giant pile of low-cost deposits. We're talking about CASA, current accounts and savings accounts. This is money that people and businesses just park at the bank for little to no interest. It's stable, it's cheap, and in a low-rate world, it becomes a bank's absolute superpower.
And having a lot of it is a massive strategic advantage. I mean, just look at Amana Bank here, with over 43% of its deposits in CASA. Commercial Bank is also in a really strong position at nearly 40%. This solid foundation acts like a powerful buffer, insulating them from the pressure of those falling rates.
Now, for banks that have a smaller CASA base, like PanAsia Bank down around 21%, the challenge is obviously much bigger. They're going to have to make some big strategic moves. Either they get super aggressive in fighting for new deposits, or they have to shift into making higher yield and maybe higher risk loans to keep their profits up.
So let's pull all these threads together with this snapshot. You can see how these different engine room numbers tell a completely unique story for each bank. You've got HNB with solid growth and just stellar asset quality. You have NDB with that jaw-dropping profit jump, but facing some real questions on valuation and bad loans. And then you have Commercial Bank showing balanced growth, strong efficiency, and a valuation to match. And just a quick but important note on the numbers we've been using. These are adjusted figures for the third quarter of 2025. We use them because they help us see the underlying trends more clearly. They might be slightly different from what you'll see in the final year-end reports, but they give us a fantastic snapshot of what's happening right now.
So, what's the big takeaway here? It's this. While those headline profit numbers look absolutely fantastic, the real story, the one that smart investors are all paying attention to, is happening deep inside the engine room. It's all about efficiency, the quality of your assets, and how stable your funding is.
And that really brings us to our final thought. As we look ahead to this new world of lower interest rates, it's a whole new game with a whole new playbook. So the question I have for you is this: which bank strategy do you trust for 2026? Let us know what you think down in the comments.